Hey everyone, thank you for joining the financial planning playbook. I have a very special guest today, Jonathon Ranello, talking about alternatives, the importance of alternatives, and why people should care about them. Thank you for being here, Jonathon.
Yeah, Andrew, thanks for having me. As you mentioned, I work with Cetera's 14,000 advisors, helping them navigate alternative investments. I've been around alternative investments since about 2012, and it's been really interesting during the last decade plus. We've seen a lot of bigger institutional money managers kind of come in and democratize access to these investments that maybe 5 or 10 years ago were limited really to pensions and endowments with super high minimums and 10 plus year hold periods.
Yeah, absolutely. It's nice that they've been relaxing some regulations because, like you were saying earlier before we started the recording, is that someone with an economic degree can have a not be accredited, but someone with inherited $1 million can be. So you were just in DC, which is very interesting, talking to legislators. Can you talk a little bit about that and what you've been seeing in the alternative space?
Yeah, absolutely. Cetera is, very involved in speaking with our legislators and making sure that they understand these are complicated financial concepts, but we want to be front and center when changes are being made. One of the things historically, the SEC had a definition of an accredited investor that you referenced, and that's one thing that we would like to see expanded today. That rule basically means you have to have a certain amount of net worth, roughly $1 million, or a certain income, $200,000 to $300,000. But that is the only qualification, for lack of a better word. And so, to your point, you could have somebody like yourself or an economics professor that just doesn't have $1 million net worth, and they're considered non-sophisticated, and they can't have access to these. And then somebody who inherits $1 million is all of a sudden accredited. So that's definitely one thing that we would like to see expanded. And again, I think originally the idea was wealthy people can better withstand the loss, but we look at it, kind of on the flip side, which is why should these investments, and we'll talk a little bit about some of the benefits of alternatives here in a minute, but why should they be limited to only the highest net worth clients, right? Why can't our farmers or our librarian clients, if it makes sense for the risk tolerance and portfolio, why can't they have access to, say, private real estate? We don't think that's a fair rule.
Yeah, I'm a huge fan of, like you said, democratizing these investments so that farmers, librarians, people who wouldn't, have access to these, but they meet an educated financial advisor who knows about these and understands the risks and rewards and how they work. I mean, I don't see any reason why someone shouldn't be able to invest in things like that. So, but before we get too into the weeds there, I want to talk high level. What are alternatives? So our guests kind of know, the folks at home listening. What are alternatives?
Yeah, absolutely. And you're right, it's a broad term that can mean different things to different people. Generally, when we're looking at sort of after tax investments, we look at three kind of main food groups of alternatives or private investments. And that would typically be private equity, where you're buying small businesses and helping them expand. It would be private real estate, things like self-storage, hotels, multifamily properties, and then private credit. I think most clients know there were a lot more banks around 15 or 20 years ago than there are today. And there's some really attractive opportunities for folks that are looking to generate income to participate in private lending. Now, more recently, certainly, that definition alternative has expanded to include some other things like maybe hedge funds or structured products. Bitcoin's obviously been popular, and then even collectibles, things like art and wine. But really, the goal of all of these is to complement the rest of your portfolio. When we really look at the total universe of companies in the U.S., about 85% of them are private. And so, the most traditional stock bond portfolio that clients have, it's very concentrated in about 15% of companies. And most economists, and really when you look at the numbers, most of the returns, the S&P has been doing great, but it's even more correlated in just a handful of those stocks, like the Magnificent Seven. So we're really just encouraging folks to look at these other asset classes and consider including them. I will say my phone definitely picked up the day the tariffs were announced, and the truth is you want to incorporate these into your portfolio before there's a market correction, right? Not when there is a market correction.
Yeah, absolutely. So I heard some benefits, diversification, non-correlated assets as well to the stock market, and just being able to invest in, you said 85% of companies are not private. So that's really interesting that people, everyone thinks of the stock market, but they're only invested in those 15%. So having that wide diversification of that remaining 85%, a lot of times there's a lot more potential with those 85% because something on the stock market, it's already priced in, it might be expensive. That's a great way to get some enhanced returns, potentially in my opinion. So why?
Absolutely, and we actually lived through that, ourselves. Avantax was a publicly traded company, the former broker dealer, and they decided to go private, right? And so there are some real benefits to not managing to your investors or the shareholders on a quarter by quarter basis.
Absolutely, absolutely. Any other alternative benefits, or can you go a little bit into why alternatives? If we haven't already beaten that dead horse, or else I can just move on to the next question.
Yeah, I mean, just to summarize, we see these as a way to reduce the overall volatility of clients' accounts. And so that really benefits investor psychology. It frankly means less calls to the advisor's office when something happens. And the truth is, it's not a political party. I mean, no matter who's in charge, there will be things that happen and it will move the market. That can be the Fed, it can be things overseas, it can be things we haven't even thought of yet, but the market, it will move up and down. And so including these to sort of soften that volatility is a really beneficial idea to complement that publicly traded portfolio.
Awesome. And I know we touched on like who should invest, or what our beliefs are of who should invest, including the librarian or school teacher. But who objectively should be thinking about investing in these alternatives if they have a portfolio that's completely, let's say, in the stock market? What percentage of assets should people be thinking about? Obviously, people shouldn't throw 100% into these alternatives, but like who should be thinking about utilizing these, and like what percentage is a good rule of thumb? Regulations, things like that, because those are also important.
Yeah, and again, lots of moving factors. Every client is unique. The way that we look at these, there are some tax advantage strategies that are really event driven. Those would be things like 1031 DSTs for property sales, qualified opportunity zones, and potentially oil and gas to offset current income. Those types of strategies are limited to accredited investors. So back to that $1 million net worth, roughly. When we look at the wider universe of alternatives, those private real estate, private credit that we were talking about before, the companies in that space, right, the Franklin Templetons, the Invescos of the world, they've really democratized these and made them available with lower minimums, with some quarterly liquidity. We always look at these as long-term investments. They're not, day trades. But we would say any client who's looking to soften the volatility on the portfolio. Also, generally including alts increases the total income coming off your portfolio. So again, really any private real estate, you can touch it. Infrastructure has been a hot topic lately, right? We all know that the roads are falling apart in our own neighborhoods. There's a lot of underfunding coming from the government. And so there's some really unique opportunities for public and private partnerships. And so, back to your question about amounts, typically we certainly would never recommend people go 100% into alternatives. We would say somewhere between 10 and 20% is a good starting point. And again, that 10 to 20% will be split up amongst a couple of those different categories, not all in one fund or strategy. Excuse me. And so, working with a knowledgeable advisor is really the best way to figure out, which one of those categories is best fit for you. And I would just encourage, there is a lot more information available publicly than there used to be. 10 years ago, we talked about a lot of these investments being limited to pensions and endowments. There wasn't a lot of educational material. There's a fair amount now that clients can learn themselves. So, encourage you to ask questions of your advisor. How long have they been using these types of strategies, right? What is their experience? We don't expect nobody bats 1,000, right? So if they say they've been doing these for 10 years and some didn't work out, I would expect that. But what did we learn, right? Why was that strategy different maybe than what we're doing today from a fund structure, from a manager selection? That is one other thing I should probably highlight. We definitely see in the alternative space a very wide range of returns between the managers. And by that, I mean, when you look at like a large cap mutual fund, the difference between the top fund managers and the bottom fund managers is relatively small. When you start looking at something like private equity or private credit, that dispersion of returns, there's a huge difference. So it's really important to pick those managers that are going to be in the top quartile if you want to have those results within the portfolio.
Absolutely, absolutely. I heard a lot of good things there, talking about hard assets, because stock market is, you know, uh, it's in dollars, and if there is a large inflation event, like we had recently, these assets tend to overperform in those type of environments. So that's another benefit to alternatives. And I heard you mention 1031, DST, throwing a lot of opportunity zones, a lot of things that people on this call may not be familiar with. Can you dive in briefly on what those are, how they work, and why someone would utilize those?
Yeah, so I mean, specifically on Section 1031, that's a tax code that's been around for almost 100 years, and it allows people to exchange one investment property for another and defer the taxes due. So the ability to really put all of your money to work instead of your net after taxes. And what we found is as clients get older, a lot of clients see the benefit of real estate. Maybe they've made, some of their money managing a few multifamily properties, but as they get older, you don't want to deal with what we call the three T's: tenants, toilets, and trash, right? And so something like a 1031 is a way to still be exposed to real estate, to still participate, but you're outsourcing that management to a professional money manager. And instead of owning, a few condos that maybe you Airbnb or you rent out, you're getting a small piece of a large, industrial self-storage property or a large hotel. So really an opportunity for our investors to trade up. Opportunity zones, similarly, they're real estate based and they help you defer any type of capital gain. So they can be used for property sales, but they can also be used for things like a stock sale. Maybe you had some NVIDIA that took off and you want to defer taxes and put that money to work. Those can all be things to explore with a dedicated financial advisor. Again, these are not available to just the general public.
Absolutely, yeah, yeah. That's great, thank you. Yeah, because those can be kind of complicated, and I actually didn't know that about the opportunity zones. You can use non-qualified money, so yeah. And Nvidia stock, you want to defer those taxes, then absolutely look at an opportunity zone, and that's definitely interesting. So, um, how does one invest in these alternatives? Because I mean, I assume, or I should say, I know that you can't just log into Schwab and buy a private credit, private equity fund. Um, how does one actually do that? How does one invest?
Yeah, and so even though you're seeing big names, Apollo and the like, Blackstone, getting into the space, these are still all distributed and accessed through dedicated financial advisors or investment advisors. And so we just think it's crucial, right? These are more complicated products. There is some uncertainty around valuation and the timing of liquidity. So it's really crucial for investors to do their own due diligence and understand those risks. Things like tax reporting, are you getting a 1099 or a K1? And so again, really crucial to work with a partner, an advisor who is familiar with these and has some experience. We even see a wide variety between sponsors. Most of those accredited deals, like 1031s, do generate a K1. Some sponsors have a very good track record of getting those out pre-April 15, and some are not quite so good, right? So even little things like that, and just really managing your expectations, right? If you as a client always file your taxes in February and you're not used to getting partnership returns, that's going to be a big change for you. If you already own 15 businesses and you file an extension every year, that's not such a big deal.
Gotcha. And is that for every alternative that a client should expect more, tax documents, or is that just uh, specific ones?
I think it's just important to understand, what you're getting into. So a lot of the bigger funds now have, changed and they're able to consolidate and do 1099 reporting more like a mutual fund, a 1099 DIV. But I think it's just important to, really understand. And these are things, again, we might focus on, say, private real estate. And we're interested in what sector are they investing or what geography. But there's a lot of these other pieces to it, right? From just the access. What type of application do I have to do, right? How often do I have access to liquidity? Is it quarterly or semi-annual? And do they have the ability to gate that or turn that off? And those are all kind of the minutia points that things can look the same, two different funds on the surface, but they might have some different characteristics underneath.
Yeah, absolutely. I know, filling out these forms, it's really figuring out two main things. It's the liquidity, like you mentioned, some have monthly liquidity, some have quarterly liquidity. So making sure that that's suitable for a client, as well as, to our point before, that they're not putting all their assets into, these alternatives. What other, where can people learn more about this? What free education material is out there that people can use?
Yeah, so there are a few, available to the public education sites through some of the sponsors like Apollo, and so that can be found just via their websites. There are some independent resources geared towards advisors also to help them, increase their knowledge, or maybe they're very familiar with, say, private credit, but they're not familiar with private equity. So I would just encourage people to, ask questions, meet with folks. Don't feel rushed. We talked about maybe a 10 to 20% allocation across a few different strategies. You're not going to come in and in 1 hour understand every. We could easily do an entire podcast, and maybe you'll have me back, or we'll bring in another guest, but you could do a whole hour on just private credit, right? And are we using this structure versus that structure? How are the loans introduced, right? Are they coming from private equity firms, and is that good or bad, right? Where did their incentives lie? Do we like middle market companies or large market companies? All these different intricacies. Lots to consider, but don't let that paralysis get in the way of including these. So, again, maybe you're somebody who's owned a little bit of real estate locally. You kind of understand how that works. Maybe you would pick to start with private real estate as the one to start with, right? And find something you like for 5 or 10% and then move on to the next. Maybe you were a small business owner and you kind of understand that your local credit union doesn't give you the same line of credit they used to, and how that lending works. You might be attracted more to the private credit side of things. Lots of information that's out there. I would just encourage people to take it, one bite-sized thing at a time, and don't expect that, one afternoon or one webinar is going to make you an expert on all these.
Yeah, absolutely. I love that. It's all about, my investment philosophy is don't invest in things that you don't understand or that I don't understand. Like, for example, I understand stock market, I understand alternatives. I don't understand, Dogecoin and I mean, I
Yeah.
do understand them, and I understand them enough to not want to invest in things like that. But like, I don't understand art, I don't understand sports memorabilia and collectibles. So, try to invest in things that you understand that you like. Is kind of what my rule of thumb is for myself, and I definitely think other people should, do the same. Any final thoughts you have for our guests today?
Yeah, the last thing I would say, you're going to hear a lot more about alternatives going forward. Again, 5 or 10 years ago, this was kind of a niche area. Few advisors kind of specialized in this. Some clients liked, this kind of strategy and being in these types of investments. You are absolutely on a weekly basis seeing these private investments discussed in more generic financial newsletters. Yahoo Finance, Bloomberg. So it's on people's minds. I think that really the next kind of evolution that we're going to see is firms, maybe like a Cetera. We're going to see firms look at designing model portfolios, and the idea would be, instead of the client having to learn about several private equity and private real estate offerings and then decide which one is right for them, it would be more of a point and click. So we determine, based on your age and risk tolerance, you should have a 10% exposure. Now we're going to automatically put you into these 3 or 4 different strategies that align with what your risk tolerance and goals are. So keep your ears open. Definitely going to be hearing some announcements later this year from a few of the big players in the space that are working on that. And I think that's really the final evolution, is trying to get multiple products into a client's portfolio and reduce the friction of the paperwork and the training and some of the things that you alluded to.
Great, great. Well, thank you so much for being on, Jonathan. I think this was really impactful, really helpful, really educational. I learned a few things, so thank you so much for being here, and happy investing. And thank you everyone from home for listening to this. And hope everyone has a great day. And thank you for tuning in.